I'm Dan Kleffler in New York, and as the financial markets are closing on Wall Street for this Monday, January 5th, this is story stock. The big story on Wall Street today, the market's steep sell-off, the Dow plunging over 350 points at one point today. The broader S&P 500 shedding nearly 2%. In fact, stocks around the globe sold off. Crude continued to slide, and troubles in Europe are mounting. Hello, everyone. I'm Dan Kleffler, here to explain what is going on in the financial markets. I want to bring in Rebecca Jarvis, our chief business and economics correspondent, as well as anchor of Real Biz right here on abcnews.com. Rebecca, thank you for stopping by. Wish we had better news we could talk about right now. First off, I want to start with oil. What's going on?
So what you've been seeing, and this is something that started last year and now is continuing into this year, oil prices are now below $50 a barrel. That is nearly a 6-year low. And of course, as a consumer, it sounds great, and we see it frequently. Gas prices in many states now are below $2 a gallon at the pump. But there are also a number of energy companies out there that trade on our stock exchanges, the S&P 500, the Dow Jones Industrial Average. There are big name companies in the energy space, which when prices get below $50, and we've been seeing this as they've been collapsing, those companies, their stocks also collapse, and that drives down the overall stock. So
the overall slide in oil, then, I think we've got a little bit of an economics 101 that we've been trying to review on this.
Sure.
Supply, demand, is it both a hand-in-hand force in all of this?
Well, one of the positives here has been that we've been producing more oil, and that's what has driven down prices. In fact, the United States now produces more oil than Saudi Arabia. We are the world's leading energy producer. But the concern is that if demand is coming down, that means if around the world companies and corporations, people are demanding less oil, that might not mean good things about what's coming ahead in the economy, because in general, a company is going to use more oil when they're producing more goods, more services. So we tend to think of oil use is something that goes hand in hand with economic growth. If demand is coming down, and we've seen it come down a bit, all of a sudden we start to question the world's growth.
The greasy, slippery tentacles of oil, I know oftentimes we think of stops at the gas pump for what we're going to actually pay for that fill-up. But really, the oil sector has a massive impact in shipping, in housing, in everything else.
Absolutely, and it can be a really good thing. I mean, there's also the upside, and the upside cannot be understated, of declining oil prices. It's great for consumers. It's great for shippers. It's great for airlines. It's great in general for a lot of different businesses, restaurants, theme parks. These are the things that tend to actually see a boost, because not only are their costs coming down, but the consumer, us, we're spending less at the pump, so we have a little more money to spend elsewhere. So by and large, it can mean good things. But ultimately, it's a new year. There's a lot of reassessing going on Wall Street, the same way that we're all looking at our lives saying, what does it all mean? What am I going to do differently in 2015? You definitely have investors on Wall Street saying the same thing. And certainly those companies that are tied to oil prices are tanking today, along with oil prices tanking. I just think that going forward, there's going to be that reassessment. And last year, keep in mind, last year was a great year for stocks. Stocks were up over 12% last year. So it wouldn't be completely out of the norm to see stocks come down a little bit.
Oil, one of the concerns that's weighing on investors' minds. Greece as well. It seems like Greece kind of fell out of favor with the headlines, and now it is back.
Now Greece is back, and it's so interesting because there was this big fear last year, early on in the year before, about what was going to happen in Greece, in Italy, in Portugal, and Ireland, some of those economies in Europe, which were really, really hurt during the recession, that were struggling to climb back, that were facing austerity, and how would they deal with that? And now all of a sudden, this question again is coming back of, is Greece going to leave the euro? Will Greece depart the euro? And it's not just a matter of whether or not Greece does it, it's a matter of what kind of ripple effect would that have? Would Italy consider leaving? Would Ireland? Would Portugal? And what would that mean for the rest of Europe? Now you have the euro, the European currency, trading at a 9-year low. That too is putting pressure on stocks. And it also is raising questions again about the whole global growth story. If Europe isn't growing, if there's problems there, how can we as the United States really expect to see positive growth for many, many more months and quarters to come here?
And there's a lot of disparity just within the Eurozone as far as each individual country's success in economic growth right now, is there not?
Well, absolutely. You have some countries that are in much, much better shape than others. For example, Germany is in far better shape than Greece. But because they all fall under one currency, right now, when you look at Europe, you have to see Europe as everybody who falls under the euro. The question is, If somebody exits the euro, then all of a sudden it's a different ballgame.
Right. All right. So back stateside, then we've got a big jobs report coming out this Friday. Then, and we've seen some positive economic data coming in here domestically. Then, are investors still long on U.S. jobs and the U.S. economy right now?
Well, investors really want to see, first of all, they want to see the jobs picture continue to grow, but they also want to see that picture of how much money are Americans making. They want to see that wage growth continue to go up. And we started to see it towards the end of last year. Finally, after almost a decade of stagnant wages, we started to see them tick up a little bit more. And what would that mean? That would mean as consumers, we're better positioned to spend money. And as of the last decade, it's been a very, very difficult slog, especially for the middle class who hasn't really seen those wages go up. And one of the issues with the job creation that has taken place in this country is that so much of it has been on the minimum income, the lower wage paying jobs. And as a result, one of the arguments that's been made for why we've seen such great disparities is that you have not seen wages go up, but you've seen stocks go up. So if you happen to be somebody who owns stocks, then you feel great, because stocks are at all-time highs. And even with a day like today, stocks are still doing very well. But if you are a wage earner and you don't have stocks and you don't have retirement savings, you do not feel that way about this country right now. And that is what we're looking for in the jobs report. More stability in the jobs market, better jobs being created, higher wage jobs being created.
It's an incredibly complex picture, and you always bring clarity to it. Thank you so much.
Thank you.
Rebecca Jarvis, appreciate that as always. And of course, you've been watching Story Stock. Stay with abcnews.com for your latest headlines. I'm Dan Kleffler.